In addition to lease incentives, another potential item that can add some complexity to our lease accounting under ASC 842 is residual value guarantees. The complexity isn't significant, but it is enough that we should spend an episode looking at the concept in detail. To begin, ASC 842 defines a residual value guarantee as a guarantee made to a lessor that the value of an underlying asset returned at the end of a lease will be at least a specified amount. So a residual value guarantee is exactly what it sounds like. It's a guarantee to the lessor that the leased asset will be returned with a residual value at or above a stated threshold. If we think back to our 5 steps in lease accounting, first we identify whether we have a lease, then we separate lease and non-lease components and allocate the consideration accordingly. In step 3, we classify the lease, and here residual value guarantees can have a significant impact. The 4th criterion of the classification test states that a lease is a finance lease if the present value of the sum of the lease payments and any residual value guaranteed by the lessee that is not already included in the lease payments equals or exceeds substantially all of the fair value of the underlying asset. To determine whether we meet this criterion, we need to understand residual value guarantees. Paragraph 842.10.30.5f states that at commencement, lease payments include amounts that are probable of being owed by the lessee under residual value guarantees. Under US GAAP, probable means likely to occur, which most literature places at roughly a 70 to 75% threshold. So imagine we have an equipment lease that includes a clause stating that at the end of the lease term, the lessee will return the equipment to the lessor, and at that time the fair value of the equipment must be at least $50,000. And if it's less than that, the lessee will pay the difference. If at commencement, our analysis suggests that the fair value at the end of the term is most likely to be $40,000, we would include $10,000 as a lease payment at the end of the term. This applies to both the classification test and the initial measurement of the lease liability, because $10,000 is the amount that is probable to be owed under the residual value guarantee. The important point is that we do not include the full residual value guarantee. We include only the portion we are probable to pay, which is often far less than the maximum guarantee amount. With that understanding, let's look at a real-world example, the last new contract we'll look at in this series. Previously, we leased warehouse space in Denver, and now Precision Industrial is going to lease a cargo van for use at the warehouse. Looking at the lease, there are a few items to highlight. First, the original lease term is 48 months, beginning on June 1st, 2026 and ending on May 31st, 2030. Then in the payments section, we'll note that the monthly payments begin at $1,100. But we also see a couple things we haven't encountered before. First, notice that for this lease, payments are due on the last day of each month, whereas every lease we've looked at before this required payment in advance. Now, in reality, this is highly unlikely to be the case in a vehicle lease, which will nearly always require payments at the beginning of the month, but it's useful to look at a different example. It will change very little in our process, but we'll have to remember it when we enter this in our workbook. Then another new wrinkle, for each year of the lease term, the lease payments will be updated for changes in the CPI, assuming the CPI increases. This means our payments are variable lease payments that depend on an index or rate. For now, we don't need to focus on this, but keep it in mind for future episodes. We will come back to it. Then, in addition to our monthly payments, we'll also make an upfront payment of $3,000. Payments like this are very common in vehicle leases. Next, some basic lessee responsibilities, and then we have this residual value guarantee. Let's look at the rest of the lease and then we can come back to this. Finally, on the last page, you see we have a renewal option. We can renew the lease for 12 months at our discretion. And as we've seen in all our leases, basic language around default, governing law, and this lease being the entire agreement between the parties. To account for this lease, let's assume a few things. First, as a policy election, we've decided to use the practical expedient available to private companies to use the risk-free rate as our incremental borrowing rate for our vehicle class of right-of-use assets. Because this is a policy election by asset class, we must apply the same election to any future vehicle lease. Second, assume that in our initial analysis, we are not reasonably certain to exercise the renewal option. And third, assume that purchasing this cargo van outright instead of leasing it would cost $57,000. This information should be easy to find. The same dealer leasing the van to us would likely also sell it directly, and we should be able to get a price for that. Now let's look closer at the residual value guarantee. It states that the lessee guarantees that the fair market value of the vehicle at the end of the initial lease term will be equal to or greater than $27,750. And that drops to $23,000 if we elect to renew. But we determined earlier we are not reasonably certain to exercise the renewal option, so we'll focus on the $27,750 for now. Because of the residual value guarantee, we also need to estimate the fair value of the vehicle at the end of the lease term. This requires significant judgment, but one potential approach is to research the price of the same model from 4 years earlier. We can find the price of that older van when new, then use a resource such as Kelley Blue Book to see the current value of a 4-year-old model with mileage comparable to what we expect for our leased van. This allows us to estimate 4 years of depreciation, and we can then apply that depreciation percentage to the current sale price to estimate the fair value at the end of our 48-month lease. Assume our analysis suggests that a similar van with comparable wear has depreciated roughly 55% in 4 years. Our estimate of the fair value at the end of the lease would then be $25,650, which is the original $57,000 less $31,350 of depreciation. Under the residual value guarantee, which requires the fair market value at the end of the lease to be at least $27,750, we believe it's probable that we will pay $2,100 to the lessor at the end of the term. We will now include this $2,100 payment in the last month of the lease when determining lease classification and initial measurement. With that covered, we'll stop here for now. In the next episode, we'll enter this information into our workbook and see how the residual value guarantee affects our accounting.